Yeah, these are all the little dynamics of fund buying that are really worth understanding because there's a lot that crosses over with the stock buying world, but then in many other ways, it's its own discipline. Understanding what makes a good fund, what makes a good fund manager, what can derail a fund. It's an art in itself, and it's an art that I love. And over years, I've written a lot about this and I talk a lot about it. And particularly when I was learning the trade, I would love finding a new thing where you'd be like, oh, that explains why that happens.
Hello and welcome to the Fund Your Retirement podcast. Today I'm delighted to introduce Simon Evan Cook. Simon is a multi-asset fund of funds manager with over 25 years experience in the investment industry. He began his career with Fidelity and joined Premier Asset Management in 2006, where he built his reputation as a senior member of the award-winning multi-asset team. He then joined Downing in 2022 to set up and manage the Downing Fox range of funds. Simon shares why his investing strategy focuses on active fund managers. He shares what he looks for in the top percentile of fund managers from around the world and debates the merits of passive funds versus active funds. Just before we get started, please remember that all opinions and other information are for educational purposes only and do not constitute investment advice. Investing carries a high level of risk and is not right for everyone. Always do your own research and seek financial advice from a regulated financial advisor in your country before making any financial decisions. With that being said, let's get started. Hello, Simon. Good to see you today.
Hi, Lee. Lovely to be here.
Thank you for agreeing to do a podcast interview. I heard your episode with Merrin Talks Money and I thought it sounded really interesting and I wanted to have a conversation with you myself. So here we are.
Thank you. Yeah, all credit to Merrin on that front. She's a brilliant interviewer. She set a high standard, so no pressure on you, Lee.
No, I'm not even in the same league as Merrin. But what interested me was the fund side of things. A lot of our guests have been stock pickers. You specialise in funds, and that really interested me. And I wanted to learn and understand a little bit more about that, why you focus on funds, which we will get to shortly. Because first of all, as I like all my guests to start off with on the podcast, I like them to start a little bit about your story, your journey, and how you got started in investing.
Okay, how far do I take it back? I guess going back to growing up, I was somewhat interested in investing. I wouldn't say I was obsessive about it. I wasn't one of these kids who didn't do anything except get the Financial Times and have his own portfolio. But my parents were kind of into it and they sparked a little bit of interest. But that wouldn't be for me where it started. I would say that I was a bit of a wandering minstrel for a while. And I just ended up in the financial service industry, largely because, firstly, my dad was an accountant. So I think that naturally just pointed me towards financial realm anyway, just because I didn't have a better idea, or the ideas I had were so ludicrously far-fetched that remotely realistic. Yeah, that dictated what I studied at school, and then what I studied at school dictated what I studied at university. So I studied economics and accounting at university. The best thing about studying in accounting was it taught me I didn't want to be an accountant. That's not for me. But with that type of degree, it naturally then inclines you to end up in a financial type of industry. I grew up in the southeast of England. There are a lot of companies, not just in London, but nearby as well. One of the first jobs I had was at Fidelity, which happened to have a big office near where I lived. So I fell into the industry. I'm not one of these people with these incredible stories of focus and born knowing that they wanted to be a fund manager. So I got into the industry and I did various jobs within that, but not being a fund manager to start with. So I had various different things, maybe working on the sales side of it, maybe working on the marketing side or on the product side, lots of experience. But I remember having opinions in all that time as well and looking at what fund managers were doing. And this will come back onto this later, but I do remember sitting in fund management firms and scratching my head about what certain fund managers were doing because they seemed to be, in a lot of cases, just copying the benchmark. You looked at what was in their top 10 and it was exactly the same as the top 10 that somebody else held and the top 10 of the index. I just ended up thinking, what's the point of view? Anyone could have done that. So I remember having that thought early on, but I was not in a position to do anything about it. I actually, at that point, decided I wanted to pursue something that I felt I was good at and I did enjoy, which was writing, funnily enough. I've always enjoyed that. I've always enjoyed the communicating side. And actually, within financial services, that was something I could do. So I thought, focus on writing, you enjoy that, a career that will take me 40, 50 years, and I'll have a good time while I'm doing it. So I did that and I got very good at that. And I ended up joining a company called Premier at the time. And I joined as what's called an investment specialist. So I wasn't a fund manager at that point, but I joined a team with a view to doing the fund manager's writing or doing the fund manager's presenting. So I joined that team, and I was in that team for about 6 months and doing a good job for them. One of the fund managers of that team then left, and the lead fund manager of that team said, actually, Simon, I'm quite impressed with what you do. I think you've got the right skills to actually do this job. It was a fund of funds team. Do you fancy the job as a fund manager? And I took his arm off. Absolutely. It wasn't something I thought would be for me, but when it was offered to me, I thought, yes, this is amazing. I would love to do this for myself. And ever since then, it electrified me for whatever reason. And a lot of people struggle with their careers in deciding what to do. But when you find something that completely gels with your personality, it does. That's the right word to use. It electrifies you. Mix of competition that's in there. You're up against other people, the intellectual pursuit of working out how to do it and then getting good at it. All of that is absolutely in keeping with parts of my personality. The fact that you have to be somewhat different to the crowd to actually be one of the best in this game. Again, that suits who I am. I always like to zig when everyone else is zagging. So for me, it just worked completely. So that's where I started off when I got my break being a fund of funds manager and never looked back.
Brilliant. What a great story. And as with Rosemary and Judith, it's clear that you found your passion and you do what you love and you get paid for it. It's well done.
Yeah, and I think it's so important because a lot of people, again, we're getting quite deep into fund picking territory here, but there's a lot of people currently in the fund management world who are doing that job because their parents told them to do it or because it seemed like a good job. It's not their following, it's not their calling. It's almost like sometimes you meet a doctor and you think, why on earth are you a doctor? And you know what their origin story is. They've got pushy parents who said, you should be a doctor, you should be a doctor.
Yeah.
So they become a doctor and they hate being a doctor, and it's not how their brain works. They'd much prefer to have been a ballerina or a fireman or whatever it might have been. And actually, that would have been the thing that would have made them happy. But they're doing a job because it's seen as the type of job you want to do. So absolutely, when you find that thing, it's all consuming.
Yeah, we touched on a little bit earlier there that you particularly specialize in funds. For the audience and myself, would you mind sharing what's your overarching investing strategy? What are the guiding principles that identify what you're looking to invest in?
So first up, we hold on the equity side of what we do, i.e. shares, stocks and shares. We only hold active fund managers. Now we can get into why that is later on. But in terms of keeping things as simple as we possibly can, the strategy I have is to find fund managers who are very good at picking stocks. That's about as simple as I can make it. Now, in terms of what that means in terms of picking stocks, I quite often use the example of imagine if you were going to buy a second-hand car for whatever reason, and you're not a car expert at all. You'd want to make sure that you picked a good car, and then you'd want to make sure that in 5 years' time you can sell it on so that you haven't lost a load of money buying that car. So I've asked this up and down the country, and I asked people, if you could take two people from two different professions with you to help you buy that car, who would you take? And immediately, a lot of people say, well, I take a mechanic, right? That's obvious. So I'd want them to check out the car and make sure that the quality of it is absolutely right. And that absolutely, I'd do that as well. But then people stumble on the second profession that they take along. The second profession that I would definitely take along would be a second-hand car salesman. The reason being that they know what that car costs. So it's no use buying a perfectly serviceable and working VW Golf for £25,000 when it's only worth £10,000 because you've immediately lost a load of money. And it's interesting that people forget that in the car example, but it's also interesting that people forget that in the investing example as well. It's you've got to check the quality and what you're buying, but then you need to make sure you're paying the right price for it. So if you want to drill it down to something very simple, and there's a lot more to what we do, but ultimately that's it. You will be buying, if you're buying one of my funds, a portfolio of ultimately stocks, held through funds, but stocks where someone has checked the quality of that company. They check the balance sheet, the management, the competitive situation. Is it going to grow? Is it going to fall? And then they've worked out, is that a fair price that you're paying for it? And that's ultimately it. We don't get involved in a lot of stuff about predicting where interest rates are going, or is Donald Trump going to be elected or is he not? And what happens if he does, or what happens if Ukraine gets worse or better? Because that stuff is basically unpredictable. Certainly to keep predicting that stuff is nigh on impossible. But can a human being identify a good company and work out if it's a good price? Absolutely they can. Yeah. So that sits at the heart of what we do.
So if I'm right in thinking here, you actually hold a portfolio of diversified active fund managers who then in turn hold a portfolio of diversified stocks.
That's exactly it. Yeah. So when you look at the Fox fund, so let's take the Fox 100% equity fund. That is a portfolio of funds. So there's Japanese equity funds, UK equity funds, global equity funds. So you'll see in there about 35 different funds. If you were to ignore those and then just look at the stocks we hold, actually about 1,000 stocks. Now, that's a lot of stocks. But the most reassuring thing I can say about that is that every single one of those has been deeply checked by a human being who is an expert in what they do and thinks about a company as if they own the company, and probably most importantly of all, have got their own money invested in their own fund as well, and therefore in that company. So that's almost the most important thing, is that you're owning a lot of stocks, but everyone has been checked, and everyone now has got not just my money, because I buy my own funds too, but the money of the fund manager who is picking that stock as well. So you can rest assured that your money is sitting alongside all the people who are making the decisions all the way down there.
How do you assess these fund managers then when you're looking to add that fund to your portfolio? What types of things are you looking for in an active fund manager?
So there's a science to this and there's an art to this. And if you speak to different fund selectors, because there are lots more people like me, I'm very long way from being the only person who does this, obviously. You will see different styles, different ways of doing it. I'm very much more about the artistic, if you like, the human side of it. And ultimately, what we're looking for is someone who is doing something that works, that is very good at that, has got good judgment, and that I can trust. Those three things are probably the biggest three things. And this is where I have some sympathy for people who are trying to pick funds themselves. I trying to pick the best UK equity fund or the best global equity fund, is that I, as a professional fund buyer, because I'm controlling a lot of people's money and I get access to the fund managers. So by far the most important bit of fund selection for me is sitting down with that fund manager and trying to work out what they do. Are they good at this job? Does the process they have work? And is this a trustworthy individual? There are more numerical, data-based ways we can look at this as well, past performance, how they performed in certain market conditions. But all of that absolutely just backs up the primary thing for us, which is that we are trying to find exceptional active fund managers and put them together in a portfolio so that the man or woman on the street can just invest their money and know that it's very well spread. There's not any one gigantic risk that they're taking, but they've got a whole series of amazing investors who are working hard to make sure they get more for their money than they might in a tracker or an index.
Quite a nice segue there. You mentioned a tracker or an index. The mainstream media would have us believe that we can just simply buy a tracker and buy an index and that's sufficient. What would you say to that? What are the pros and cons of an index or a tracker versus what you do by active fund managers?
So I guess that's lots of different ways of answering that question. Back in my youthful days, so I'm 49 now, but you take me back 20 years to when I first started becoming a fund manager and making these decisions. I was quite a firebrand about this. I absolutely believed in active management and I hated passive fund management. I'm a little bit more mature now. The best thing about a tracker or a passive fund, take a fund that tracks the global market or the UK market. The best thing about that is if you are a personal investor who just wants to invest their money in the market and doesn't want to spend any more time thinking about that, doesn't want to think that they are overly exposed to one particular company or one particular risk, and they also don't want to feel like they're overpaying for something and getting nothing. A tracker has been a brilliant development. And for some people, absolutely a tracker will be the right thing for them. And there's a whole load of literature that's sprung up about this. And generally, if you read the press, they are very pro-tracker. And even if you read the writings of Warren Buffett, even he seems to be pro-tracker, despite himself being obviously one of the most successful active investors ever, as evidenced by the giant pile of money he's got. But he seems telling you one thing while doing another. There are people out there who are exceptional, who are well above average. And if you can invest alongside someone like that, and all they have to do is make you 10% a year when the market makes you 8%. Now, that seems like a small difference, but when you compound that over the life of a pension investment, for example, or even if you've just retired and you want a pot for your kids that you're going to become an inheritance, and that's potentially another 20, 25 years, that 2% extra turns into, depending on how much you originally invested, but tens of thousands of pounds, hundreds of thousands of pounds difference. The magic of compounding turns that 2% into so much more than 2%. So that's what I like, is the belief that if you can find exceptional fund managers, you will do a little bit better in the short run and you'll do a lot better over the long term. So the trick is then obviously, how do you find these exceptional fund managers? The passive salespeople tell you it's just luck, right? If you give enough monkeys, enough typewriters, one of them's going to turn out the collected works of Shakespeare. But there's been enough collected works of Shakespeare in the investment world, i.e. amazing fund managers who have turned out track records which look like Warren Buffett's. Warren Buffett's not the only guy to have done this. The difference between Warren Buffett and most amazing fund managers is that he's been doing it for about 950 years or
Yeah,
whatever.
somewhere close.
He's got that compounding. The thing about compounding is it starts slow, and then the longer you go on, the more exponentially amazing it gets. So if you can do it for 40 years, it's incredible. If you can do it for 80, it's ridiculous. And he's the evidence of that. But there are plenty of them out there who show that if you do certain things reliably, and they're quite simple things as well, it's basically the thing I mentioned at the start. If you can find amazing cars that are perfectly sound and you buy them at less than they're worth, you're going to do well. And ultimately, that's it. So yeah, for me, the active passive debate has got skewed. There is the biggest myth out there about active fund management, is the biggest argument against it is that the average active fund can't outperform the market. Now, that is a myth, because it's been a logic that's been explained to people. So here's basically the argument, and correct me if I'm wrong on this, Lee, but you'll have heard it the same. It's that when you add up all of the investors or the active investors in a market, they are the market. So when you then take their charges off that, the average one will underperform the market. And so therefore, if you can invest in the market, i.e. a tracker, but at lower charges, you are guaranteed to beat the active fund manager. Now, that is wrong in my eyes on a lot of levels. The most obvious one to me is that actually the average active fund manager is not the market. If you take the UK market and you look at all the funds that are in the Investment Association's UK All Companies sector, when you add up how much they invest together, it comes to, I think, less than, it's either 5% or 2% of the UK market. So they are not the market. And it's entirely feasible that 2% of the market can do something different enough to justify the charges that they're charging over that market. So that is wrong from the start. It also assumes that all of those funds are the same size. You imagine a small market where there's 100 investors in it. If one of those investors has so much money that they control 51% of that market, it's entirely feasible again for the other 99 to outperform that market when you add it up, because they're not all equal. And we live in a very unequal world. And here's the best news for a lot of your listeners, is that unlike most spheres of life, being a smaller investor is a gigantic advantage in the investment world. Being a sovereign wealth fund with hundreds of billions to invest is a nightmare, because you can only buy really big stuff, and the really big stuff, in theory, isn't going to grow all that much. Whereas actually, if you're a small investor, you can find nice little investments which might even double your money or do even better than that, because you've just got so much more choice. The final thing to add is that I've just put up a defense for the average active manager. I'm not in the business of defending the average active manager. I'm not interested in the average active. We're only looking for the exceptional ones. So much as that argument about the average manager may or may not be right, ultimately I don't care, because I'm really only looking for the top 2 or 3% who are very different to everyone else.
Yeah, it's like any discipline in life. There's always the exceptional ones, isn't there? There's that top level.
Yeah.
We were discussing football before we started, weren't we? That
Yeah, we're mid-Euros. Yeah,
mid-Euro, so the very top percentile of the footballers that we see in the Premier League week in, week out, or at the Euros at the moment, the amount of actual people who have tried to get to that level is probably hundreds of thousands globally. But there is that elite level. Is that the area that you're aiming at? You're aiming at the elite level, and that's who you aim to have in your fund.
Yeah, it absolutely is. And if you've ever played football or ever run against an actual proper elite athlete, it's a humbling experience. That's exactly what we're aiming for. Yeah, we want those exceptional individuals, and they are rare. And they're becoming rarer as well because the world at large is increasingly becoming spreadsheet driven, and you've got to pass a certain number of exams and you've got to do X and Y and Z. And actually what you're tending to find is that whole structure, not just in the fund management industry, but almost any industry, is separating out people who are good at passing exams. But that doesn't make you a great fund manager. Actually, the worst thing about that whole structure is that it is separating out the slight mavericks, if you like, the people who think differently, the people who are the ziggers rather than everyone else is zagging.
Yeah.
And actually, what you really want in an elite fund manager is someone who is so completely devoted to what they do that they don't care what anyone else is doing. They don't care what the market's doing.
Yeah.
They are entirely focused on what they do and how they operate and the type of company that they're happy to look for and the process they're running, that they will not deviate from that. But actually, most fund managers end up getting swayed by the competition or what's happening in their market. And they end up just becoming very clever sheep.
So what I'm curious to know is, how do you find them? Because the many guests that I've interviewed on here, they have screeners for finding stocks. They attend AGMs and listen to the management. Do you have screeners? Is it screeners much the same way as when people are analysing for stocks?
I'll answer this in two halves then. We do use screens occasionally, but it's very far from even the most common way we find these managers. We are screening. What we're really looking for are almost the extremes within, let's say, again, 100 fund managers. Let's say it's Japan. What we're really looking for are the extreme funds in that. So we either want ones who are at the top of that list, particularly over the longer term, or we want ones who maybe over the shorter term are actually right at the bottom, possibly even fund number 99 or 100.
And what the metrics for having them top and bottom? Is it percentage return, compounded return? Is that what
it would be percentage return. So what we're really looking for there is actually we're trying to isolate the ones who are doing something different. We want the ones who are completely focused on the path. And so they tend to end up with track records that look very different to how the market. So it could be returns. If you were just trying to buy a fund as an individual, you might want to buy someone who is at the top of the table, but you give a lot more weight to someone who's been at the top of the table for 7 years or 10 years, because that's probably given enough sense that they haven't just caught a wave in the last 3 months where they happen to get a couple of things right and it's been luck. So we're always trying to remove luck from the equation. But in terms of giving us a pool of funds to look at, what we do want to find is the funds who are doing something different. So again, in terms of screening, we will look at those funds that are either end of the scale. We might look at other metrics as well, like active share. Now, active share is a number that you can use if you're looking at funds. And what it basically tells you is it's a percentage, and the higher the percentage, the more active you like that fund manager is. So if you're a UK investor and you've got an active share of 99%, it means that when you look within your portfolio, only 1% of that portfolio matches the benchmark. A tracker will have an active share of 0. So it is the market. So we are looking for funds who are genuinely active in that. The rub for us is actually those fund managers, I think, are the best fund managers. But I will put this warning out there. They are the hardest to hold as well, because when it's going well, they might be, the index has gone up 10% and maybe they've gone up 30% in a year. They will be that type of fund manager. That's great. That's exactly what you want. There's nothing wrong with that. But that can reverse as well. So in a year when maybe the market's up 30, sometimes we might be holding a fund that is only up 15. So they're a long way behind. So the emotional strain of holding a fund like that is a lot harder than owning a tracker, because you have to question yourself in the periods when it's going wrong. So we talk about this as calling it the hero's journey of funds. So when you look at any one of the funds that we hold in the Downing Fox portfolio, any one of those funds I think is amazing. But also, if you were just holding that one fund, it would be very difficult to hold, because over a 10-year period, there might be 5 years when it's amazing, 2 years when it's average, but 3 years when it looks god awful. And so the reason we call it the hero's journey is because this is a template that any great movie follows, where it's not a boring journey. It's not like my commute to work this morning, where that sometimes becomes heroic depending on what the trains are up to. It's about that kind of Luke Skywalker journey, where at the highs he's blowing up the Death Star, and at the lows he's lost an arm and he's in a pit somewhere and it's all going horribly wrong. That's entertaining. If your money is invested in that fund, it is a hard thing to do, particularly in those abyss, and it will test your patience. So we like those types of fund managers. The reason why they're on that journey is because they tend to focus on a very specific way of investing. Maybe they're looking for the best companies in the market. Maybe it's the cheapest companies in the market. Whatever it might be, it will look great and then bad and then great, and it will be hard. The trick about what we do is we find these amazing active fund managers, but we're well aware that anyone who holds our funds doesn't want to go on the heroic journey. We call ourselves as trying to create the unheroic journey. So we try to find, while one fund manager is operating very differently to another fund manager we own, and when they're in their abyss, we should hopefully have another one who's going through their kind of moment of triumph. You saw that in 2022, where a lot of people bought growth funds, really high growth, high technology weightings. They've been amazing for 10 years, and then they were awful for a year, and they've been good for the last 18 months. That's what we're talking about. But we had those types of funds, but we also had value managers on the other side who were doing the exact opposite. And they had a wonderful 22. Actually, and when the market was down, we had value funds that made money in that year. And that makes the whole experience of holding our portfolio a lot easier. But at the end of that 10-year period, you should still get the amazing returns from these fund managers, but it should just be easier to hold along the way.
So how long do you hold fund managers for? Many of the guests we've had on here who have described their strategy, their philosophy, some of them have held stocks for decades, certainly
Yes.
a lot of years. How long do you hold your funds for? How often do you change out?
The ideal holding period is for us forever. Yeah, what we're not trying to do is guess. We're not going to say this is a value manager, they've had a great run, we'll get rid of them and we'll bring in a growth manager. We don't do that because I've seen people try to do that and it doesn't work. You get the timing wrong and you end up causing more damage than not. An ideal investment for us is we find a fund manager who is, I don't know, let's say 42 years old, and they run for another 23 years and they're very good at what they do. And there's nothing that gives us any reason to sell that fund because I don't want to be doing any more work than I have to. So if I found a great fund manager and they run that fund the way that they should do, and importantly, they keep it the right size, then I want to be holding that fund for life. I don't want to keep reinventing the wheel. In practice, what will tend to happen is that some of those funds will have to sell well before 10, 20 years, maybe because the fund manager's left, possibly we've got it wrong, or maybe that fund manager decides actually that they're going to go off piste. We thought they're a value fund manager, but for whatever reason, they abandon their discipline and do something else. Or the most common thing for us is because we're quite good and have been quite good at picking successful funds. And this is the most counterintuitive thing, I think, for retail investors, is that actually the most common reason to sell is a fund has got too big and is too successful and popular.
Okay.
When you look at the great fund managers, quite often the thing that stops them being great is they're just running too much money. So Warren Buffett, absolutely this applies to him. When he was running much smaller amounts of money, his returns were far better than they've been for the last 10, 20 years. The reason being that when you are running a fund of, say, 100 million sounds like a lot of money, but in fund management terms, that's quite a small fund. That's almost ideally sized. Let's say you're running a UK equity fund that can go anywhere, that can buy smaller companies, mid, large caps. What you really want to be able to do is if you find an amazing idea that is a smaller company that is, I don't know, it's a tire manufacturer operating out of a part of the UK, but they've got this amazing tech that makes their tires more fuel efficient than anyone else's, but they're small. If you're running a gigantic fund, you can't buy enough of that company to make a difference to your fund. So if you're running £20 billion worth, you can only buy 30% of that company at max anyway. And that causes its own problems if you do that. And that 30% owning of that company might represent just 0.1% of your fund. So even if you're right and that stock doubles, that means your 0.1% of the fund goes to 0.2. Nobody is going to notice that. It's a rounding error. But if you're running a smaller fund and you put 5% of your portfolio into that smaller company, that great idea, and it doubles, that's a 5% hit right there. And you notice that. So as a fund manager, you want the ability to put a proper weight into your best ideas. On the other side as well, if you're a fund manager running a big fund and you own that company and it's done well for you, if you own 10, 20, 30% of that company and you think, actually, you know what, this company's done its thing now. It's become too expensive, or there's a competitor out there who's got even better tires. You've got to sell your position in that. You can't, because everybody in the market knows you're the biggest holder. You selling that stock is going to tank its price. And this is effectively what happened with the Neil Woodford issue. He was running a very big fund in the tens of billions at peak. He was holding big parts of companies that were very small companies. And while that fund was growing, he was taking bigger and bigger positions in these companies. He was actually driving the share price upwards. So he was making the performance of his fund look good. When everyone started to exit that fund, he had the opposite problem. So he had people withdrawing money, and actually him selling the stocks that he owned was driving the price down. And every other fund manager in the market was going, Let's just look through Neil Woodford's portfolio. What does he own? Let's stay away from that for 6 months because he's going to have to sell that. And so there was like an air pocket where the prices dropped. And then once he finished selling, all the other fund managers can pile in and say, that's so cheap now. He stopped
Yeah.
selling it. And then that stock will recover. But you
The
end up.
damage was done there, wasn't it, to
It
the
absolutely
investors?
was, yeah.
Yeah.
Yeah, these are all the little dynamics of fund buying that are really worth understanding because there's a lot that crosses over with the stock buying world, but then in many other ways, it's its own discipline. Understanding what makes a good fund, what makes a good fund manager, what can derail a fund. It's an art in itself, and it's an art that I love. And over years, I've written a lot about this and I talk a lot about it. And particularly when I was learning the trade, I would love finding a new thing where you'd be like, oh, that explains why that happens. And I find fewer of them now. The low-hanging fruit for me has been picked, but occasionally you find something new that you didn't know about fund management. I love adding that to the arsenal of things that I'll check on a fund. And so effectively, that's what we do. We do that on behalf of our investors is we find the amazing fund managers. And then when they're in there, we just want to make sure that we are on top of them, the person. Are they still motivated? Because that's the other thing. Sometimes actually it's not the size of the fund, it's the fact that this fund manager has proved themselves and maybe that fire has gone out a little bit. Maybe they've earned the money they wanted, maybe they've beaten the rival they wanted to beat, and they're just not into it as much as they were, but it's earning them some nice money. So it's up to us to sit with that fund manager and see whether they've still got that hunger or not.
And I can see you have the hunger for this. 100%, it's clear.
Yeah, I love it. I love it.
Yeah. And you also mentioned there's a lot of crossover between this and the stock picking. I can see that the way you've been describing here, but it also sounds like that's probably a topic for another episode as well, by the sounds of
Yeah,
it. I could
absolutely.
tell it's that broad in there that we could probably go on for another hour just about that area.
It is a proper can of worms if I opened
Yeah.
it. Absolutely. Yeah. When you look into this, you see there's so much more to it, and there's so many fascinating elements and so many great stories as well of funds that have triumphed and failed and blown up or made their investors tons of money. It's an amazing toy box to peer into.
Well, I think we should do that.
So I'm on. Yeah.
Yeah. This has been brilliant and obviously respectful of your time and the audience's time for this episode. As we come to the end, is there any sort of final myths that you'd like to bust around the passive versus active investing that the audience may or may not have as they're listening to this? Anything you think we've not covered?
Yeah, I think for me, it's just drawing it back to why a lot of people are disillusioned with active funds. Now, part of it is the cost, right? They are definitely more expensive, although that gap has dropped. I think why so many people have become disillusioned with active funds is because they think they're a con. And the reason they think it is a con is because they tend to find very good fund managers. Actually, people are very good at finding good fund managers. They are lousy at timing that. And what I mean by that is they tend to remember that heroic journey I was talking about. And a great fund will be on that heroic journey. What people tend to do is wait until that fund has outed itself with this amazing track record. So it's done well over 3 years or even 5 years. They think, right, that looks like an amazing fund. But actually, when you know the fund management world, you know that probably it's, think of again, a movie script. That's probably the kind of pride before the fall moment. What was working for them reverses. Most people end up buying at the peak of the performance, and then they only experience that fund doing badly. And then maybe after that, they'll go, okay, I got that wrong. That guy was a con man, or he wasn't as good as I thought. But actually, look at this fund here. This is top of the tables. It's 3 years, 4 years, but amazing number. And I'll do the same thing again and then experience the same thing again, where that fund then just turns. And once you've done that once, twice, 3 times, you begin to think it's either a con or it's just a matter of luck. But actually, once you understand that there are cycles and fund managers will be good and they'll be bad, you understand that and you can stay within that fund. So I think that is the big misunderstanding that I get from people who've dabbled in funds. It's that sort of misunderstanding that it should outperform every year. The best funds absolutely will not outperform every year. The best funds will be a long way ahead and a long way behind. It's just understanding that and therefore being ready for that journey if you're just buying one of those.
And I suppose, again, linking it back to stocks or stock picking, most of these fund managers will be specialized in a particular area of, say, stocks.
Yeah.
And inevitably, that area of stocks and that stock market will go through cycles, won't it, of good times and bad times.
At the time of us recording this, the biggest company in the world is Nvidia. And but there is, you think about the emotional journey behind what that's made a lot of money. it's gone up a lot. So there's either individual investors thinking, that's amazing, I want some of that, so I'm going to pile into that stock because I want it to go up by the same amount. Or there are fund managers there who think, oh God, I haven't held that and I look terrible versus everyone else. So they're piling in. So at that point, actually, people aren't thinking about how good that company is or its valuation. They are just thinking with their emotions. I want some of that, I have to have some of that, or it's greed or fear, whatever it might be. And it's when your emotions are taking over that really some of the worst mistakes happen. So yeah, and then that turns because actually, if you're the last buyer of that stock and everybody who's left to buy that stock is, or fund or whatever it might be, has bought it, there's no one left to buy the stock to make it go up anymore. That is when it starts to turn and actually people start to sell it and it drops a bit more and it drops a bit more and then other people sell it and then finally you get the reverse happening. So yeah, it's a pernicious game, but with a bit of knowledge, a bit of patience and the right people on your side, actually it can be quite a lucrative one. It's a very much a get rich slow type of world though. I think if you're trying to make a fast buck out of it, then you're probably going to end up.
Yeah, but I think the majority of money is made slowly over time, isn't it? The media presents the quick, the fast sort of success stories, but ultimately the ones you never hear are the slow burners in the background over time.
It's get rich slow and survive trying to paraphrase.
I like that. Yeah.
The way I look at it, yeah.
And do you just only specialize in stocks then, or fund managers who pick stocks? Or do you have fund managers that specialize in bonds or commodities or things like that?
There are fund managers out there that do that, but for us, in terms of the way that we've set up, and again, this is potentially another can of worms we've been into. So yeah, on the non-equity side, we only use government bonds and cash. The reason being that when you look at our fund range, we've got basically 4 funds. There's 100% equity, which is our neat whiskey, if you like, and then we dilute that down for people who can't handle neat equities. Because even with the way that we do it, which we think will be less volatile over time, it's still more volatile than some people could handle.
Yeah.
So we dilute that down using cash and government bonds. In cash and government bonds, I don't think active fund managers can add any value because you think about a gilt fund, there's only one issuer of gilts, it's the UK government. So the fund manager doesn't add any value there. In the world, we don't own corporate bond funds, but there are very good corporate bond fund managers out there who, if that's the kind of thing you're looking for an income, for example, those fund managers, I think if you pick a good one, they're going to do a great job for you because they're picking, in the same way an equity fund manager is picking different companies, that's what they're doing as well. It's just that they're looking at the bonds they've issued rather than buying a share of that company. So we don't buy them, but there are good ones out there.
Yeah, brilliant. So as I said earlier, there's a lot of big talking points in there that we could probably extend this for many multiple hours. So I think we should probably think about another episode. But just to finish off the podcast episode, as I do ask all guests that come on, what book would you recommend or podcast for the audience to listen to then?
You know what? Actually, I've got an entire book list that I put out there. I've recently started running something called the $1 Billion Book Club. Also with that, if you go on to bookshop.org, I have a little kind of sub shop on there. And I have to be clear, I'm not packaging the books myself and sending them out. It's just a front on this electronic store. Bookshop.org is great because actually they send a lot of their money to local booksellers, and I love books and I love local booksellers, so that's great. And I'm also associated with a charity called Fairfield Enterprise, which is doing great things in our industry. But on that, if you search for $1 Billion Book Club on there, there is a list of 10 fund or book picks I put on there, and I put the reason why, and with them a kind of investment tip as well that book taught me. But one book that isn't on there that I would recommend that I think is quite good in terms of understanding how I think about the world, I think it's called The Little Book of Value Investing by James Montier. And he is someone who is a brilliant mind, he's a very different thinker, and he describes a lot of what I believe, which is in terms of just understanding that type of investing where you understand the quality of a company, the price you pay for it. It's a very approachable book, relatively easy to get into. So that's a good place to start.
Yeah, brilliant. And I will make sure those links are in the show notes just below so you can easily get to them through the links. And where can the audience learn more about you, Simon? Where can they connect with you, follow you, or learn more about the Down in Fox funds?
So the best place to connect with me would be if you go on to medium.com, and again, we can probably put a link to this in the show notes, but I'm there, so I write bits on fund selection and the like, fairly accessible stuff. I do also write for a publication called CityWire, and so you might, I think if you go onto their funds insight, you can see some of my regular columns on there. Yeah, eventually once you start looking, you'll get sick of me. So
there's a lot of content there then.
It's not too hard, yeah.
Yeah, as I said, I'll make sure those links are below there for you. So Simon, this was really good. I really enjoyed it. So thank you for your time.
Likewise. Thanks, Lee.
Well, that's it for another episode. If If you enjoyed this episode, please subscribe and leave us a comment to let us know. And don't forget to check out our other investor-related podcasts on the Fund Your Retirement Podcast Network. I hope you have a great day, and thank you for listening.